Okay, so we are back in action here, and let's do a more realistic example. So let's consider a 2-day accounting period during which CS buys a container, and they also buy some components to put in the container, some bay windows. Um, and that all happens on day one. And on day two, they note their mechanic has been working for 2 days at $400 a day, to convert this container in CS's shop. And they note that rent and electric for the shop is $100 for the 2-day period. By the way, their shop can only handle one container at a time. So their mechanic is devoted to just this container, and the rent and electric for the shop is just for this container. And then finally, at the end of the second day, that was quick, they sell the container for $25,000 and invoice the customer. So let's see if we can record all the journal entries for these and do some financial statements for this period. Okay, so first thing, you can see there's a little bit of cheating going on here. You can see these grayed out, but clearly when they buy the container, we have inventory for 15,000 going up, and that's an asset, and they were invoiced for that. Very trusting seller there. 15,000, and that is, of course, a liability that they have to pay, and it's accounts payable because it's evidenced by an invoice. Okay, and also on the same day, at the same time, they buy those bay windows, so that's part of the inventory for this container. It's adding value to this container so they can sell it for a higher price than they bought it for. Okay, and they did pay cash for that bay window, so we'll record that. And these are, of course, both assets. So when you buy the inventory asset, you do not expense it at that time. Comes in as an asset. All right. Now let's go back and take a look. So at the end of day two, they note that their mechanic has been working for 2 days at $400 a day. Sounds like $800 to me on the container. Okay, so they're noting this because we're going to do financial statements for this 2-day period. Okay, and whenever you do financial statement, you have to sit around and think and note what are the things that have been accruing, usually liabilities, but not always, that you're going to have to pay for, expenses that you've accrued but haven't paid for yet, and you do not have an invoice for them. So that's what this is about with 3 and 4. So we have 800 for the shop employee, okay, and then we have 100 for rent. Okay, that shop employee is absolutely needed to turn that raw container into a saleable item. Okay, so her salary is part of inventory, it's part of adding value to that container to make it something that they can sell for a higher price. Okay, she was not paid, she's a salaried employee. Okay, so that means they have a liability to pay her, which is not AP because there's no invoice. You don't get invoices from your salaried employees. So I'm going to say accrued salary, and I'm going to put inventory here. If you don't do this, it's not points off or bad or anything like that, but it's good to do because let me fix that. Okay, because if you're working in a real corporation here, the CFO is going to say to you, if you're working for the CFO, well, of our accrued salary, how much is for inventory and how much is for other things? So if you just put the inventory there, very easy to tell her what's going on. So that's what I'm doing. Okay. All right. Also, this is going to help with cash flow statements later on. You want to know where that came from for your cash flow statement. And then down here we have the rent and electric for the shop for the 2-day period. That was $100. Definitely rent for the shop is included because the shop is absolutely necessary to convert this, and the electric, same deal. Need the lighting in the shop, need the electricity for power tools, all that stuff. And that was not paid either, so that's going to be accrued rent and electric liability. Okay, so that's a CR because it's an increase in liabilities. And also, same deal, I'm going to put for inventory there in parentheses and 100, and that is a liability. And of course, accrued salary is a liability, not an asset. So go up there and correct that. Okay, so that's 1 through 4. So now, finally, at the end of the second day, they sell the container and invoice the customer. So they sell it for $25,000 and invoice the customer. Okay, so first thing I would want to do, I always do the easiest thing. Easiest thing for me is no matter what type of firm you have, when you sell something, you recognize that revenue. Okay, you have a party, recognize the revenue, and then you just have to note down, did you get cash for that? Did you invoice it? Was it a note? So these guys invoice, they're pretty trusting themselves. Here they invoice the customer for that, $25,000. So that's accounts receivable, and it's accounts receivable because it's evidenced by an invoice. Okay, so this is our asset, and revenue, as we know, is always equity, and CR is increase in equity, and DR is increase in assets. So debits equal credits. Everything is looking good to me there. So that's the first thing, is we want to always declare the revenue. Okay. And what's our next step going to be with industrial entities? We match the expense. So this is the how do we avoid fraud jail issue. We always want to ask ourselves, so now do we still have that inventory? And the answer is no. So we have to credit the inventory at cost, always at cost. Inventory comes in at cost, it goes out at cost, unless we have to write it down along the way. Okay, so now we need to add up everything that has gone into this container, and I think that you're going to find it 16,900, which equals 15,000 plus what, 1,000 plus 800 plus 100, everything that went into that, and that's an asset. And then the final thing we have to do here is when we remove this inventory, when we sell it, where does it go? That's when we recognize the expense, cost of goods sold expense. Okay, and that's for the total cost of the inventory item that we just sold, including labor and electric and stuff like that that was directly needed to make that inventory into a saleable product. So that's expenses are, of course, equity. There are always decreases in equity, so that makes them DRs. And I think we have here some of the DRs equal some of the CRs. So we're all looking good. Okay. All right. So let's create now income statement and change in balance sheet for the period beginning of day 1 through journal entry 4, beginning of day 1 through journal entry 5. Okay, so what I've done here just to help us out a little is I've just sorted all of our journal entries by AL and E and then by account. Okay, so you don't, of course, need to do this. all right, by ALE, then by account. You don't need to do this. I'm just doing it because it's going to help us out rather than going right back to the journal entries. Okay, and so what I have is 1 through 4 in black, and red is item 5, which is when they sold the reconditioned container. Okay, reconditioned and repurposed, right? Okay, so here's our change in balance sheet for entries 1 through 4. Okay, so our inventory, as we know, if we added up everything in that 2-day period, was 16.9K. Cash went down by 1,000, right? Because we paid for the bay window with cash, okay? And that leaves us with a total of 15,900 change in assets in the period. Okay, for liabilities, we got invoiced for the container, okay, and we had our accrued expenses of 0.9, that's the rent and the electric and the salary. Okay, so total liabilities at the end of this 2-day period, except for selling the container, 15.9 thousand. Okay, and we have changes in owner's equity in the period, or 0.0K. So do we have changes in liabilities and equity equals changes in assets? Yes. No change in equity because we didn't have any revenue, expenses, paid in capital, or dividends in the period. So that better be 0. Okay. And the income statement for that period, like I just said, we had no revenue, we had no expenses, so we've got 0, 0, 0, 0, 0, nothing happening in terms of the income statement for the period. All right, now let's look at the entire 2-day period, including selling of the container. So now we do have some revenue. Okay, we're going to have our revenue of 25. Oops, that's 25,000. Okay, and we have our COGS expense. We convert all of that inventory over to COGS in entry number 5. Okay, so that's 16.16 comma. Oh, 9 there. Okay, and that gives us for the period net income of 8.1 thousand. Okay, so that's looking pretty good there. And let's see what our balance sheet for the whole period looks like here. Okay, so we have cash. We also have at the end of the period that accounts receivable. We invoiced our customer for 25K there. Okay, and the inventory now is 0 at the end of the period. Because we converted it all to COGS, right, in item number 5 when we sold the container. Accounts payable, we still have to pay for the trailer, okay, and accrued expenses, that's the employee's salary and the rent and electric. We're going to have to pay that someday, and I think that's it. You can go back and check me, but I don't think there's anything else there. Okay. So I'll just leave that blank. Okay, now how did owner's equity change? Well, no paid in capital, no dividends. So we just look back to see the change in net income. That was 8.1K. So we can just drop that right in there, 8.1K. Okay, and I think if we add up 15.9 plus 8.1, we get 24 for total liabilities and equity, and that equals our total change in assets for the period, so everything is looking good. Okay. Okay, so now let's think about writing down inventory. Okay, so here's an example for container space. So they use this gypsum board faced insulation for these trailers. These trailers are all steel, as you know. So they're going to get cold, they're going to get really hot in the summer. So you want to do something like this. This also gives you a nice interior surface. You can paint spackle and all that jazz. So they had 2,000 of chipboard faced insulation left in the rain and ruined. It now has salvage value of $500. So let's see how we're going to account for this. Okay, so first thing, as always, you ask the question, can they use that as inventory anymore? And that's no. So we have to remove all 2,000 of that from inventory. Okay. And then we did get, through some kind of immaculate conception, here we did get salvage value of 500. So in other words, someone is going to buy that. I don't know what they're going to do. Maybe they're going to scrape off the gypsum because the styrofoam should still be usable. They could scrape off the gypsum and spray paint it or put foil facing on it, something like that, and then sell it as refurbished rigid insulation. So that's who they're selling it to. They're going to pay them $500 for that. A rigid insulation recycler, refurbisher, someone like that. Okay, and so by definition, now this is, we've seen this before with PPE. By definition, the net amount of the write-off goes to inventory write-off expense. Okay. Okay, and that's an expense. Okay, and you could have the word expense in there if you wanted. You don't need it. That's fine. But remember, same thing happened with PPE, and we said by definition, the net amount of the write-off would be PPE write-off expense. Okay, so here, of course, it is inventory, which, so we say inventory expense. Okay, and that's that. All right. Okay, so the general implications, inventory of course has to be written down whenever current value falls below cost. That's what we call the lower of cost or market strategy. We always use that. Okay, write downs always incur an expense, as we've seen before. Okay, and especially for inventory, for anything, but especially inventory, you want to write down as soon as the value falls. You don't wait until you match the revenue, right? This is part of being conservative, okay? So as soon as the value of inventory falls, you write it down, okay? All right, so here's another simple example. This is a scene from On the Waterfront with Marlon Brando. This guy has a boat full of quickly ripening bananas at the Hoboken docks, and Marlon Brando is head of the Teamsters, and he's saying them bananas go bad in a hurry. He's looking for a big bribe to get these bananas unloaded quickly, otherwise it might take a week or two to unload them, and then the value of the bananas isn't going to be anything. Okay, so let's consider something like a supermarket where we have a batch of banana inventory costing 2,000. It's ripened, but it's still saleable. Can still sell it, okay, but for less than what they paid for it. So they're ripe. They maybe have little brown spots. They're not great, but they can still get people to buy them. In this case, notice how you can, here we're writing down to COGS. Okay, so let me just fill in what we do here. So we definitely say the inventory value has been reduced by 400, and here they just say COGS expense. Okay, so we're writing down to COGS here instead of okay, and so you can do this. You can do this when the the inventory that you've got is still usable as inventory, right? In the previous example, they could not use that as inventory anymore. No ifs, ands, or buts about it, okay? But in this example, with the bananas are still inventory, all right? So that's why they had a choice there. So let me talk a little bit more about that because I've seen some interesting examples with home building companies when still be okay. I bring this up because in the Great Recession, we bought a bunch of bonds of home builders that we thought were in bad shape but weren't going to go bankrupt, short-term high yield bonds. And in doing our research on those, we noticed that some home builders were writing down their homes if the value of the home had fallen below the cost for them to build them. Some were writing down to inventory write-down expense, and some were writing down to COGS. And of course, as a potential investor, it gives you much more information to see inventory write-down expense than COGS. If they say COGS, you don't know if the cost of their materials has gone up or what's going on, but if you say inventory write-down expense, it's very clear. So we would try to steer away from firms who wrote down their home values to COGS instead of inventory write-down expense, just on the general principle that they were shifty and trying to be obfuscational. Okay. All right. So last thing about this is that in the big bad real world, sometimes we postpone the conversion of inventory to COGS when we sell something. And this is not a fraud jail type of problem, but what happens is, for example, through the summer, Container Space might be selling containers, and they're busy. And so every time they sell one, they'll just record the revenue. And then at the end of the summer, when they're ready to do their Q3 financial statements, they will go to an erstwhile intern or someone low on the totem pole in the accounting or treasury department, and they'll say, here's everything we sold in the Q3. Now we have to match the expense and move all that stuff out of inventory before we do financial statements. Otherwise, it's fraud jail. So here's how it would work with our Container Space example up above in the 2-day period. So right away when you get the inventory, you record it. And then as soon as you sell the item, you record it. But then you're a busy company, you're not doing financial statements for a few weeks. You won't record the matching of the expense right away, but you just have to be sure that you don't forget to do that, and you got to make sure you do it before your next set of financial statements comes out. Okay, just a little real world tip there. Okay, all right, and that's it for this chapter. And let me put in finished here, and we will see you again very soon.